Let's talk about tense-dependent exchange in the situation there's assumption of the liability, which is when you assume the other party's mortgage, or your mortgage is assumed by the other party in the tense-dependent exchange. IRS say, for the purpose of figuring the realized gain, so you add any liabilities assumed by the other party to your amount of the realized gain. So if any liability assumed by the other party will increase your amount realized, right? Then subtract any liability of other party you assumed from amount realized. So if you assume a mortgage of other party will reduce your realized gain. So at the bottom say, for the purpose of figuring the recognized gain. Recognized gain is a taxable gain. If the other party to a non-taxable exchange assume any your liabilities, you will be treated as if you received money in the amount of the liability. So basically say, well, if your mortgage is assumed by the other party, basically is equal to the cash you received. This, when your mortgage was assumed, means this is a boot. You received that as a cash. Let's see an example. This is an example given on the IRS Publication 544 on the page 16. So let's see the example. You exchange real estate held for investment with an adjusted basis $8,000 for other real estate you now hold for investment. And the property you gave up was subject to $3,000 mortgage for which you were personally liable, and the other party in trade agreed to pay off the mortgage. So basically, the other party assumed your mortgage $3,000. The fair market value of the real estate you received was $10,000. You also receive $1,000 in cash. You pay $500 in exchange expense. Let's see how this works. So what's the situation to you? What's the value you're going to receive? You receive the new property, the fair market value is $10,000. You receive $1,000 cash. You assume your mortgage was assumed by the other party, which means it's a cash received to you. So you receive equally like you received the cash $3,000. Then this is amount you received, right? It's $14,000 you received. Then less the expense. Expense is $500. $500. Then you less your old current basis on your older properties basis $8,000. So you realize the gain is $5,500. This is the amount you realized, right? What's your recognized gain then? So not yet. Your recognized, if you watch my other video, will say your recognized gain is the lesser your realized gain and all the boot you received. So let's say your realized gain is $5,500. Then your boot received is $1,000 cash and plus mortgage for $3,000. Total your boot is $4,000. So you then also you have a pay money out is $500. So this will reduce the amount of cash you received. So that's why your recognized gain is $3,500 here. So your realized gain minus the recognized gain is your deferred gain is $2,000. So basically, in this transaction process, you are subject to capital gain tax on the $3,500 in the year of your exchange. Then you can defer $2,000 gain here, right? This is your deferred gain. Once you know your deferred gain, you can find your basis in the new property. So your new property fair market value is $10,000. Then you defer $2,000 again. Then your new property basis is $8,000. You can see here $8,000 is exactly the same basis in your old property basis. So basically, once you done exchange in this property, you receive this property $10,000. If you turn around to sell it, then you have to recognize $2,000 again, right? Let's see what's the IRS calculation process. IRS exactly do the same thing. Say you received is fair market value. You received cash $1,000. You received mortgage assumed by other party. You received total. You received is $14,000. Then minus the exchange expense is $500. So which is the amount you realized is $13,500. So then your realized minus your adjusted basis. This is amount your realized gain. The IRS say, well, the amount realized gain, the realized gain is recognized taxable up to only $3,500. So let's see. Basically, just say, well, your realized amount is $5,500. Your recognized amount is taxable amount only $3,500. This is how IRS calculated. Say the money you received $1,000. The mortgage assumed by the other party is $3,000. Total $4,000 minus the expense. So this is your recognized, which is your taxable gain here. Okay, let's see another example. Here I have a little note just to say, well, when the usually IRS said if you have money pay out of pocket during the exchange, they may increase your basis in the new property. However, in this situation, because your $500 paid is used to reduce the recognized gain, so you do not increase your basis. So that's a little note. This is another example. So basically, the other party assume your mortgage and you assume the other party's mortgage as well. Let's see the example. Say you exchange the real estate held for investment with adjusted basis of $8,000 for other real estate you now hold for the investment. The other party assume your $3,000 mortgage and the fair market value of the real estate you receive is $14,000 and you assume $4,000 mortgage. You also receive $1,000 in cash, pay $500 in exchange expense. So let's see the situation. You receive the new property's value, $14,000, receive $1,000 cash, and your mortgage was assumed by the other party, $3,000. So this is amount you received. Then what you out of pocket is you will pay $500 expense. Then you will assume the other party's mortgage $4,000. Then your basis give up is $8,000. So total your recognized gain. So total you received minus your total give up. So you will have a recognized gain is $5,500. So what's your recognized gain then? I hear it's zero. So then your deferred gain is $5,500. Your new property is $14,000. Then your deferred gain is $5,500. So this your new property basis is $8,500. Here I kind of say, well, you have extra $500 payout pocket, you can be used to increase your basis. However, let's just see IRS interpretation. So IRS exactly did the same thing. They say, well, the amount you received is $18,000, then minus the exchange basis expenses is 500. So your amount realized is 17,500. Then what's your adjusted basis minus adjusted basis 8,000 minus the mortgage transaction is. So then your total recognized gain, you can see here, is exactly the same. This is your realized gain. Then the realized gain, is recognized taxable gain only up to 500. I'm not sure here is correct. So basically, you receive $1,000 cash, then your mortgage was assumed is $3,000. So total, then your mortgage assumed, you assume $4,000. So basically, this is even, right? Even. Then total money unlike property received this is very interesting. Well, you already evened out $1,000. So they basically say, I say, unlike property received, you receive $1,000 cash, then minus the expense you paid, you still recognize a $500 again. I just don't buy this. Anyway, so that's on IRS website. So I would say this is again to the other party, not you. So anyway, so from my understanding, I would think your property basis increased to 8,500. Because during this process, you received boo is 4,000, you give out is 4,500. So the 500 should be increase your basis. So if you turn around, so you have a deferred gain is 5,500. If you turn around sell the property, you have to recognize this gain. So anyway, so that's how I interpret it.